Welcome back to Alpha Robusta. Today, we're diving into the world of finance and investment as we explore 10 powerful strategies for balancing your investment portfolio. Whether you're a seasoned investor or just starting out, finding that perfect balance is crucial for long-term success. Today, we will talk about 10 strategies for balancing your investment portfolio. So before we get started, make sure to hit the like button, also subscribe to my channel. 1. Role of each asset class in a balanced portfolio. Just as an orchestra needs a blend of instruments to create a rich melody, a balanced portfolio requires a mix of asset classes, each playing its unique role. Stocks. These are the growth engine of your portfolio, offering the potential for high returns. Bonds. They provide stability and regular income, acting as a cushion during stock market downturns. Cash and cash equivalents. They offer liquidity and are a safe haven during market volatility. Real estate, a good source of diversification, offering potential income and growth. Commodities. They add further diversification and can act as a hedge against inflation. 2. The importance of asset allocation. Asset allocation is the grand strategy of your portfolio. It's the decision of how much of your portfolio you allocate to different asset classes: stocks, bonds, real estate, cash, and commodities. Why is this so crucial? Well, research suggests that the majority of a portfolio's return variability over time is determined by asset allocation. In other words, the choice of what percentage of your portfolio you invest in stocks versus bonds versus other assets has a greater impact on your portfolio's performance than the specific stocks or bonds you pick. It's like choosing the proportion of ingredients in a recipe before worrying about the specific brand of those ingredients. 3. Allocating assets based on risk tolerance, investment goals, and time horizon. So, how do you decide on your asset allocation? Remember those personal factors we talked about earlier: your risk tolerance, investment goals, and time horizon. They play a crucial role here. Risk tolerance. If you're risk averse, you might lean more towards bonds and cash, which are typically less volatile than stocks. On the other hand, if you could stomach more ups and downs in pursuit of higher returns, you might allocate more to stocks. Investment goals. If your goal is to grow your wealth over the long term, you might focus more on stocks, which have historically had higher returns over the long run. If you're focused on generating income, you might allocate more to bonds, which pay interest regularly. Time horizon. If your goals are many years away, you might be able to ride out the short-term volatility of stocks for the promise of higher long-term returns. But if your goals are closer, you might want to focus more on preserving your wealth with safer investments like bonds or cash. 4. Strategic versus tactical asset allocation. Asset allocation strategies can broadly be divided into two types: strategic and tactical. Strategic asset allocation. This involves setting your target asset allocation based on your long-term financial goals and risk tolerance, and then largely sticking to it over the long run, regardless of short-term market fluctuations. Regular rebalancing is used to bring your portfolio back to its target allocation. Tactical asset allocation. This is a more active approach, where you temporarily deviate from your strategic asset allocation to take advantage of investment opportunities presented by market conditions. It requires a good understanding of the markets and investment principles, as well as the discipline to revert back to your strategic allocation when the timing play has run its course. 5. The concept of diversification. Diversification is like the proverbial advice: don't put all your eggs in one basket. In the world of investing, it means spreading your money across different investments within each asset class. So instead of buying shares in just one company, you buy shares in several different companies across different industries. Similarly, you buy bonds from different issuers, invest in real estate properties in different locations, and so on. Why would you want to do this? Well, just as variety is the spice of life, diversification is the spice of investing. It adds flavor to your portfolio and reduces the risk of any single investment dominating your returns. 6. The role of diversification in reducing risk. Think of diversification as your portfolio's superhero, protecting you from the villainous risk. Here's the magic of diversification. Different types of investments often perform differently under the same market conditions. While one investment may be down, another might be up. By holding a mix of investments, you're aiming to smooth out the inevitable ups and downs of the market. Even if one stock tanks, you've got plenty of others that could help counterbalance the loss. Remember, while diversification can help reduce risk, it doesn't eliminate it entirely. It's not a guarantee against loss, but a powerful tool to manage the level of risk you're comfortable with. 7. Different investment vehicles. Individual stocks. Buying shares of a company makes you a part owner. It's exciting, isn't it? You get to participate in the company's growth and potentially receive dividends, which are a portion of the company's profits paid out to shareholders. Bonds. When you purchase a bond, you're lending money to the issuer, be it a government or a corporation, for a fixed period of time. They promise to pay you a fixed interest rate and return your principal when the bond matures. 8. Building your portfolio. By now, you've journeyed through the conceptual forest of investing and navigated through the thickets of terminology, theory, and tactics. The result? You're standing at the edge of a beautiful vista with all the tools you need to build your own balanced investment portfolio. So let's roll up our sleeves, don the financial hard hats, and build the financial future you've envisioned. Begin by asking yourself, why am I investing? Are you saving for retirement? Do you want to buy a home or pay for a child's education? Maybe you're aiming for financial independence? The clearer your goals, the better you can tailor your investment portfolio to meet them. It's like deciding on the destination before setting out on a journey. So grab a pen and paper, find a quiet place, and jot down your goals, both short-term and long-term. 9. The importance of regularly reviewing your portfolio. Regular portfolio reviews are crucial for several reasons. For one, the financial markets aren't static, they're dynamic, fluctuating entities. As the markets change, so too can the value of your investments. A stock that was just 5% of your portfolio could grow to become 10%, or a sector that was thriving might take a hit. 10. Common mistakes to avoid when building a portfolio. We've journeyed together through the exciting world of investing, building a balanced portfolio brick by brick. But just as important as knowing what to do is knowing what not to do. Yes, even in the symphony of investing, there are a few discordant notes that can throw your performance off track. Let's explore some of these common investment missteps and, more importantly, how to sidestep them. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.